The stock market showed its volatility this week, plummeting more than 500 points after the release of the most recent inflation data. Coming in much higher than expected, the Consumer Price Index created fears that the Fed will have to keep interest rates higher for longer. The extreme uncertainty haunting the markets emphasized the need for safe haven assets to protect investors' portfolio values. Now, the Dow Jones fell 525 points on the CPI news. It was the largest single-day drop since March of 2023, and it saw the benchmark erase almost half of its gains for 2024. And at session lows, the blue chip index nosedived more than 700 points, a dramatic warning for all investors of the risk that this market has built in. Now, meanwhile, the S&P 500 and the Nasdaq also fell. All 11 S&P 500 sectors ended in the red, with rate-sensitive names falling the most. The sell-off comes after the Dow hit a record high close, and the S&P 500 actually closed above $5,000 for the first time. Investors were riding a crest of enthusiasm based on signals that inflation was actually under control and the interest rate cuts were on the horizon, but that optimism crashed along with the market and the Fed releasing higher than expected numbers. The latest CPI report showed prices rose 3.1% for the 12 months ending in January, and CPI rose on a monthly basis as well. Core inflation has been even more stubborn as housing costs have stayed higher than anticipated. Both inflation measures were hotter than expected. Economists had thought that inflation would slow to around 2.9%, but the numbers showed that shelter prices and food prices drove inflation higher. Now, a drop in fuel costs caused headline inflation to hit 3.1%, but core inflation is up 3.9%. With the Middle East so volatile right now, fuel could send inflation lurching back up on a moment's notice. Now, inflation-adjusted hourly earnings increased 0.3% for the month, which looks great on the outset, but when adjusted for the decline in the average work week, real weekly earnings actually fell 0.3%. Stock prices have been rising with the expectation that the Fed would cut interest rates as soon as May. Now, however, traders don't foresee the first rate cut until June or July at the earliest. Chris Zaccarelli, Chief Investment Officer for Independent Advisor Alliance, says the stock market can't keep rallying if rates are going to be higher for longer, especially if the assumption that the Fed is completely done raising rates is incorrect. Wall Street had priced in about 6 rate cuts for 2024. They interpreted Fed signals that rates would start coming down from the 22-year highs. Atlanta Fed President Raphael Bostic squashed Wall Street's optimism by saying that he doesn't see the Fed cutting rates until the summer. Jan Hatzius, the chief economist at Goldman Sachs, says that we could continue to see the FOMC leave the Fed funds rate unchanged at the March meeting and begin the easing cycles in May. And while 90% of the market participants agree with Hatzius, the majority, 62%, don't expect any move at the May meeting at all, according to the CME's FedWatch tool. Now, expectations for June are even more iffy, with just 24% expecting a cut. And the Fed is and has always been focused on inflation. They explicitly have stated that rates will not come down until there's clear data that inflation is on a definite trajectory to 2%. With continued growth and a strong labor market, the Fed really doesn't feel the need to worry about high rates crushing the growth, but an overeager Wall Street only seemed to be hearing what they wanted to hear. Quincy Crosby, the chief global strategist at LPL Financial, said the much-anticipated CPI report is a disappointment for those expecting inflation to edge lower, allowing the Fed to begin easing rates sooner rather than later. Now, across the board, numbers were hotter than expected, making certain that the Fed will need more data before initiating a rate-cutting cycle. And Wall Street may be setting themselves up for an even bigger fall. A Bank of America survey found that investors are cutting cash holdings and plowing it into stocks. Global stock allocation is actually at a 2-year high. And it seems as if investors are experiencing FOMO on the surge of the Magnificent 7 tech stocks, but they're building on very uncertain foundations. Even a slight uptick in inflation sent the market plummeting, and overvalued stocks could fall even further with just a hint of negative news from the Fed. And with all of the risk currently built into the stock market, now is the time for investors to look for assets like physical precious metals that can protect and preserve the value of their portfolios. Even with the prospect of higher for longer interest rates, analysts point out that gold is holding very steady and looks poised for its next leg up. Worsening economic, political, or financial issues could take gold well over $2,100 an ounce. Now, if you're concerned about the current market conditions, and if you're looking for a way to get the risk off the table, I'm Mackay Block with American Hartford Gold. Give us a call today, and we'll discuss how putting physical precious metals into your portfolio or your IRA can give you the hedge that you're looking for.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.